Welcome everybody to this quarter's Trend Series webinar. We're excited to be with you all today, and we thank you all for taking the time to spend with us here on this webinar. We know it's a really busy time. It's month end and quarter end and a holiday week, or at least a long holiday weekend for some people. Are trying to get audits wrapped up this month and everything else going on. So we appreciate you carving out a little bit of time to be with us here today. And we're excited about what we have to share with you and hope that you'll find it valuable and insightful, and that the time you spend with us will be worthwhile here today. So thank you for being with us today. I'll introduce our presenters here shortly, but just a couple of housekeeping items before we get started. Everybody's on mute. If you do have questions throughout the webinar, be sure to drop those into the GoToWebinar chat function. We'll get those during the webinar and can address those questions to the extent that we have time at the end. We do have a lot to pack in today, so we may not have time to do Q&A at the end, but if we don't have time today, we will respond after the webinar today to any of those questions that come in that we don't have time to address on the webinar today. Also, this is a CPE webinar, so there will be a couple questions that pop up during the webinar. In order to get CPE credit for the webinar, you have to answer those questions. So when they pop up, be sure to answer them so that you can get the CPE credit. The webinar today is being recorded, and we'll send that recording out along with the slide deck after the webinar, either later today or in the next day or so. Also, there will be a quick survey at the end. We always try to gather feedback from those that attend just to see what we can do better, make sure that we're delivering valuable content to you guys. So if you would just take a minute at the end, it's short, and answer a few questions, it would be helpful to us. So with that, I won't take a lot of time on this because again, we have a lot to cover today, and I assume that most of you that are on the webinar are somewhat familiar with Richie May, but we've been involved in the industry for a long time and serve clients across audit, tax, a number of advisory, compliance, technology areas, and so we see a lot. We work with a lot of clients, and we want to bring some of those insights that we gain from the data that we gather and from the work that we do with clients to each of you here today, and to all that we do with our clients. So as far as today's agenda, we'll just touch on that here real briefly. We're going to cover the results of the Richie May Select peer benchmarking program for the quarter, and we'll share some of those insights and trends with you. And then we'll also touch on some opportunities, threats, some insights gleaned from that data, and just from our interactions with and the work that we're doing with clients. And we'll also be sharing some information around cybersecurity, so that you can all take a few ideas away from this that can help you better protect yourselves against the threats that exist out there in the mortgage industry right now, because they are significant. And so we hope that as we bring all this together, that we can provide some valuable insight to you guys that will help you as you leave this, and it won't just be a regurgitation of data, but that in the analysis that we've done of the data and through the experience that we've gained in working with clients, that we can help you to take advantage of some of the opportunities out there and avoid some of the threats and pitfalls that do exist, because it is very real these days. So with that, I just want to introduce our presenters really briefly. Tyler House, who we welcome back to the firm. Some of you may remember Tyler from his time here at the firm previously. Tyler is back with the firm and leads our data and analytics practice. So he'll be sharing some of the peer benchmarking data and related insights with you today. Seth Sprague, who probably doesn't require much of an introduction, most of you know, is going to share some thoughts regarding some opportunities and threats and some things that you can do to position yourself now and for future success. And then Alex Brown is a director in our cybersecurity practice, and he'll share some insights with you related specifically to cybersecurity and what we're seeing in the work that we do with clients. And so with that, I'll just hand it over to Tyler and we'll dive right in.
Thanks, Nathan. Before we jump into the numbers, I think we got a quick poll question to get things started. So kind of a fun poll question here. We're just going to ask you about how is your March Madness bracket going? A, my bracket's looking good. All my Final Four teams are still alive. B, my bracket is mostly busted already. Only a few of my Final Four teams alive. C, my bracket is completely busted. Or D, I didn't do a March Madness bracket. So we'll give you a minute or two, or maybe a couple of 30 seconds to fill that out. And while you do, I'll just share that my bracket is totally busted. You know, whenever my hometown team, Colorado State, makes a tournament, I just got to pick them to go on a run, and they went out early. So my bracket is busted, but still fun to watch March Madness this time of year.
So the reason for this poll question is to make sure that you get CPE credit. So again, if you're one of the people on this webinar looking to get CPE credit, you do have to answer this poll question and the 3 others that are following. So we'll give you about 10 more seconds. Make sure you get those answers in.
The good news is there's not a right answer. You don't have to get it correct, right? You just got to answer it. So there you go.
For those of you who want to see where you stand, most of us didn't do a bracket. All right, take it away, Tyler.
That's all right. You know, it is a busy time of year, so I understand that totally, but we'll jump into the numbers here. And so just a quick note, you know, the data for this presentation comes directly from RM Select. So that's Richie May's quarterly benchmarking program. It was started back in 2012, and we currently have about 70 IMBs who participate in the program. And so let's jump in here. So, you know, the financial results this year were really not what anyone had hoped for. 23 was another tough year in mortgage, and this chart really shows exactly that. This is the percent of lenders with a positive net income in each year since 2018. That green bar is GAAP pre-tax net income, and the blue line is net production income, which is simply an isolation of your origination platform. And the difference between the green bar and the blue line is generally the impact of servicing. About 1 in 5 lenders were pre-tax profitable in 2022, simply because of their servicing portfolio. Because of fair value changes due to mortgage rate decreases at the end of 2023, servicing just boosted fewer lenders into GAAP profitability in the most recent year. Only 18% of lenders had a profitable origination platform in 2023. So that's by far the lowest percent since the beginning of the benchmarking program, all the way back to 2012. Average net production income for the RM Select peer group was a minus 51 basis points last year, or in 2023. Even the public IMB players struggled, and we're really not cherry picking that line there at minus 92 bips. That's, you know, the list of lenders included there is really, it's an average of Guild, Rocket, and United Wholesale, so, you know, quality public IMBs. And then within the RM Select peer group, we do create a top performers group, which is defined as the top 20% in terms of net production income and basis points. And over the last decade, you know, lenders with a significant source of their production coming from builder relationships have been a top performer by that definition. And that still was the case in 2023, but because of their unique model advantages, we did pull them out of that group for this analysis. And then, you know, once we pull that group out, we're really left with only a handful of your typical, you know, small and mid-size IMBs in the top performers group that had a profitable origination platform. Some of those lenders are familiar faces and would have been classified as a top performer historically. And a good portion of them are actually new to the group. And I think the following chart will illustrate some of the unique characteristics of the top performer group in 2023. So the top performer group was 100% retail. They do about 7 to 10% more purchase mix, and that trend extends back several years. In terms of FHA and VA product, it's plus or minus about the same. And generally, they do have a higher contribution margin, which simply means it's revenue per loan net of sales compensation. And so, historically, top performers have always produced a higher contribution margin, and it's really not because they pay lower commission splits, or it's usually not because of that. But generally, it's because they have fewer layers of sales management and fewer sales support headcounts, and that trend has continued into 2023. But beyond those differences, I think this chart illustrates a primary reason for some of the changes in the group. What's obvious to see is that most lenders, represented by that green line, grew almost 3x in 2 years. But the top performers group saw more modest growth, still a lot, but still more modest. And this allowed them to be more nimble on expenses, or maybe said better, the task of right sizing from 4 billion to 1.5 billion was a much taller task than going from 2.5 billion to 1.2 billion in volume. And then the other element at play, is kind of this question of cutting expense to the bone, really to right size to 2024, versus making investments in the future. On one end of the spectrum, the top performers might have, cut expense too deep, maybe cutting into compliance or technology and exposing themselves to some risk, but they are profitable in 2023. Or, on the other end of the spectrum, lenders, continued to make investments in technology and retained higher staffing levels to protect themselves from that risk. But we don't collect that level of data in the benchmarking program, and so, we can't really say that these are at play or to what extent they're at play in these numbers. But I do think it's kind of an important discussion point, especially when you're talking about right sizing and when you're talking about sustainability of any IMB in this environment. On the topic of expenses, let's take a look at total cost to originate for the entire RM Select peer group. This is a fully loaded cost. It's all personnel, occupancy, marketing, and G&A costs. The primary costs that aren't included would just be servicing. So servicing costs if you service in-house, or sub-servicing costs if you use a sub-servicer. Costs for 2023 hit an all-time high at over $12,000 per loan. And if you look back to 2018, our last down cycle purchase market, this represents a $3,600 increase over that time period. And for once, I don't think LO comp is like the primary issue. Year over year, LO comp came down 2.5 basis points and ended the year at 125 basis points, which for our peer group is more in line with historical averages. The problem is really more on the fixed cost part of our cost structure. So in this chart, I've removed all sales costs, and we're left with fulfillment personnel, which is going to be processing, underwriting, and closing, and that's in the gray. And then back office, which is basically corporate overhead personnel in the green. And then we have operating costs in the dark blue. Now, if we look back to 2018, fixed costs represent a $2,700 per loan increase. 55% of the increase is operating costs, 40% due to back office personnel, and fulfillment personnel make up 5% of the increase. In particular, if we look at fulfillment personnel and the number of loans per FTE, it was 5.3 in 2023, only 0.2 less than 2018. And at a cost of $1,300 per loan, I think those are actually in line with historical norms, especially, in a year where we're seeing a 20% decrease in volume. I think that those are pretty healthy historically. The problem is back office personnel and operating costs. And, simply those costs were just too high for the volume we saw in 23. The other trend that's pretty interesting is really in margins. So in basis points, we hit a low mark in 2023, and they were also 62 basis points lower than they were in 2018. So you can see the basis points in the gray bars. But the other factor at play is average loan amounts have increased significantly in the peer group, which will make margin and basis points look like they're compressing. But on a per loan basis, which is indicated by that green and blue line, it's a little bit of a different story. We actually see that over the longer term, a secondary gain on sale and contribution margin per loan are higher than any year, not 2020 and 2021. So I bring this up because most of us, there's still some work to do in 2024 to get to profitability. And one of the questions, I'm asking just with my finance background is, right, if contribution margin per loan is greater than it was in 2018, why can't we get to profitability? And I think that's a really good question and a good exercise to go through internally. I've been through those exercises in the last few years, and I imagine that most of us will come out of that exercise observing that, number one, we built our cost structure to support a $4 trillion market, and not all of that cost structure is going to be easily unwound. It's going to take some time, and it's not going to happen overnight. Number two, to use an overused term, there's a new normal to some extent in our cost structures. Not only did we build up infrastructure, but we also added costs. We added to our tech stack, and many of those additions are here to stay. Inflation has increased benefits and G&A costs, and compliance, including cybersecurity related costs, all continue to add to the overall cost structure. And so the baseline for costs going forward is probably not an $8,000 per loan cost like we've seen historically. It's probably a bit higher. And if that's the case, margins are too low where they are today, and we do need to push on margins. That is, push them a little bit higher until we get too much pushback. There also needs to be some more work done on costs. If we look at the run rate fixed costs where the peer group exited 2023, and if we assume no change in variable unit economics, then we need 35% more volume in 2024 to reach break even. I don't think we're going to see that this year. I could be wrong, but the MBA is forecasting 22% year-over-year increase. Maybe the volume comes in 2025, but we really need to continue to develop a plan for our cost structure that finds the right balance of getting more efficient and lean, but also doesn't leave us exposed to risk. And it also has an eye towards setting us up for the future. As the saying goes, it's in these challenging markets when lenders set themselves up to really make their money. And so with that, I'm going to pass it on to Seth Sprague to continue this discussion.
Great, thanks, Tyler. And I'm going to cover some random thoughts here. Opportunities, threats, and insights. As the data suggests from RM Select, right? It's been a challenging year. There's no doubt that 2023 was a challenging year. We're hopeful that 2024 is a little bit more profitable, probably in the second half of the year. But I think the first thing that everyone wants to talk about is rates. But before we get there, we got another poll question for you. And remember, you have to answer all four of these questions in order to get the CPE credits. So when do you expect the Federal Reserve to first lower the federal funds rate? You can answer Q2, you can't answer Q1. That one's off the table. I think that was what we were hoping for, or a lot of people were hoping for. But Q2, Q3, Q4, or sometime in 2025. And as you're kind of mulling this over, I was talking to some folks last week in DC, and I like to throw out once in a while a topic and just see what response was. And it's an election year. And I said, well, what's the chance that the Fed actually doesn't lower interest rates until after the election? And the answer was, there's a chance of that, and it's above zero. I think we're all hoping that the Fed, or at least the originators are hoping that the Fed's going to cut rates faster, but inflation remains sticky. So again, you got to answer all four of these CPE questions to get your credit. And Gabby, how are we doing on participation?
Like, we have almost all the votes in, so I'll give you just a couple more seconds here.
All right, and we will take a snip of this and send this over to Chairman Powell so he knows exactly what we need him to do for the rate change that everyone's expecting. And not surprisingly, most of you are in my camp. I think it's Q3. I actually would vote Q4. I think it's a little optimistic. Maybe it's Q2. Maybe it can be. But as we look at inflation, it remains sticky. And I think there's a strong chance the Fed doesn't do anything until after the election because they don't want to be viewed as political, but we'll see. That doesn't necessarily mean that mortgage rates don't move downward. And as we kind of go to the next slide, let's look at what the Fed funds futures are telling us. And again, this number changes every day. So, as soon as you pull it, it's going to change. The general expectation, despite where inflation sort of sits today, is 2, now 3 cuts in 2024. We'll see if that gets peeled back to more like 1 or 2 as we go throughout the year. But the general trend obviously is that Fed funds rates will come down, therefore mortgage rates should come down as well. And this is just the expectation of several rate cuts this year, more rate cuts next year, and then several rate cuts even in 2026. And remember now that the 10-year Treasury rate to mortgage rates remains wide, so we'll see how that plays out. As we go to the next slide here, let's look at the rate forecast. And again, these forecasts get changed daily. Mike Frantantoni and the team at the MBA obviously does a monthly forecast as well. This is just from U.S. News and World Reports, where we're pulling rates. And again, this is just 30-year fixed rate mortgage rates. And if we kind of look at where most people are expecting rates to be, kind of in that 6% range by the end of this year, and maybe more like 5.5 by the end of 2025. I will say this, having been in this industry a long time, whatever the rates forecast is, it's going to be wrong. It's going to be wrong too high, wrong too low. There is general consensus, obviously. There is a little bit of difference with Fannie Mae with their forecast, as rates coming down a little faster than Wells Fargo and the MBA. But we'll see how this plays out. It'll be interesting times, obviously, for 30-year fixed rates. There's a lot of factors here that can drive 30-year fixed rates different than just actually Fed funds rates. As we go to the next slide, the one thing to look at here is the spread to Treasury rates. I think historically this number is 184 basis points. I didn't look where 10-year Treasury was. I knew it was north of 4 last week, but I mean, we should be closer to probably high 5s, low 6 mortgage rates, and we're more like high 6 mortgage rates. So I think what will change this, and this is one of the opportunities out there, is that once the industry, once the experts are convinced that the Fed will not raise rates, I think there's some narrowing here that will occur on treasuries. The other factor that Chairman Powell talked about was, they're going to start de-levering the bank balance sheet, or their balance sheet, meaning that they're going to sell some of those UMBSs that they bought, propped up the market in 2020 and 2021. I think once the market sees how those transactions go, this spread can narrow. Said another way, mortgage rates can move down way before the Fed actually starts cutting rates, or way before the Fed actually gets through with their Fed cuts. So we'll see how this plays out. The spread remains wide. This is certainly an area of concern. Some people have talked about Fannie and Freddie should be buying UMBSs on their balance sheet. I can tell you that's not going to happen. So we can park that idea for another day. But this wideness to treasuries, maybe this is a new historical norm, as Taylor talked about in his presentation, or side of the presentation, right? There's a lot of new norms out there. Maybe we were just wide to treasuries. Maybe, as I was talking to some people last week, maybe United States Treasury debt isn't the real risk-free rate, and maybe this spread will actually narrow due to the quality of mortgages. I think there's a lot of factors going on. When you kind of get the side eye that United States may default on its debt at some point, maybe this historical analysis is no longer valid. As we go to the next slide to take a look at this, this is from U.S. News and World Reports again, and I just pulled this because I thought it was interesting on home buyer sentiment. But a lot of home buyers are waiting for rates to drop, whatever that means, right? Is that 7%? Is that a different number? Among those looking for more, they want to see them below 5% before buying. Well, based on that data I showed you, they're going to be waiting an awfully long time. There's going to be a lot of housing appreciation as soon as the Fed cuts rates and more people are in the mortgage market. About half the 2024 home shoppers are planning on buying new construction, as Tyler pointed out in his presentation. That builder relationship's critical, right? And so that's kind of thematically what you're seeing in this industry. And of course, everyone's planning on refinancing to lower rates in the future. I don't understand how that's three quarters of the current buyers, right? So again, the buyers are going to know that they could get a lower rate in the future. They'll accept it, get the house in now, and then refinance in the future. So again, that's opportunities for you for all that recent production, including what's going on in 2024. These buyers want to refinance, they're savvy, and there's opportunity there. As we look at the next slide, Fannie Mae speeds. This is from Wells Fargo Securities. This is just a flash report they put out. This is February speeds. And I put this as an opportunity here, and I'm going to flip it around to be a threat later. But high coupon or higher coupon servicing, 6.5% Fannie Mae UMBS and 7% is prepaying above a 10 CPR. Low coupon stuff, still not prepaying very quickly. But notice in February, across the stack, everything prepaid faster than January. Okay, so we're off the seasonality lows of January. We're on that upward trajectory of prepayment speeds. We're on that upward trajectory to home buyers. We're off where rates were historically high. The recent historically high, they've come down. So there's some positive trends out there on the origination side of the business. If we go to the next slide, let's talk about some threats. Okay, so what's probably the largest threat out there to me is what's happening in the Ginnie Mae space. The Ginnie Mae prepayment speeds, if you are not actively recapturing loans, December 2023 speeds, look at those CPRs, 6% coupon, a 5.6 CPR, 6.5% coupon, 7.7 CPR. Tyler, let's go to the next slide and let's look what happened in February. 24 CPRs, 17 CPRs. If you don't believe in the Ginnie Mae space, and these are pools that are 6 months old and 10 months old, if you don't believe out there that speeds can get faster than expected very quickly, there's a little blip in rates down at the end of the year, and all of a sudden prepayment speeds are 24% on 6.5% Ginnie Mae securities. So think 7% mortgages, right? 25 CPR, okay? That is dramatic, that's fast, that is an opportunity, it's a threat. It depends on what side of the house you're on. If you own servicing and don't have the ability to recapture, this is a threat to you. If you own servicing and have the ability to recapture it, this is an opportunity, okay? So Ginnie Mae speeds, hypersensitive and way more sensitive than Fannie or Freddie speeds. Another threat that we're going to talk about in the next slide is FHA performance, everyone's favorite topic. Remember, we're trying to attract more first-time home buyers. Overall delinquencies on FHA loans, as this is the December FHA loan performance report, overall delinquencies are at 12.69%. And this gives you the delinquencies by just a couple cuts, purchase versus refinance. Oh, shockingly, those that refinance are more current. Well, that's because they can refinance, right? So as you think about those pools that are prepaying, the opportunity is you can refinance them. The threat is what's left behind may be more delinquent. Credit scores, a ton of people are looking at different credit score matrices. It's double-digit delinquencies across the board, with the exception of those 720 plus FHA FICOs. And as you get below 620, it's more than 20% delinquent. Those are servicing advances. This is a threat to your cash flows. Okay, so again, opportunities and threats are kind of on different sides of the mirror, depending on how you're set up, depending what your strategy is, and depending whether or not you have servicing. But FHA delinquencies, they're high. They're always high. On the next slide, one of the other things we want to talk about is the MSR asset. Everyone knows I can't have a whole presentation without talking about the MSR asset. As Tyler pointed out, Q4, sort of a dog for MSR holders that weren't hedged, right? Took some write-downs, rates fell. They're going to be recovering some of that value in the first quarter this year. But servicing carried the day in 2020, 2022 and 2023, first 3 quarters. And remember, that MSR write-down is non-cash. Folks that have retained servicing are still enjoying tremendous servicing cash flows from that servicing retained portfolio. So even though they may have had a hiccup in the fourth quarter with a loss on their MSR value, tremendous cash flows are being generated from the servicing portfolio. It is a volatile asset, though. You need to manage it and you need to be aware of it. We'll go to the next slide. And the final slide before I think we get to the next poll question is inflation has remained elevated. And if you've gone to the gas station, you've gone to the grocery store, inflation is sticky. We've gotten it off the 9% numbers, but we're having a hard time getting it below 3%, right? Fed has a stated objective that long-term they want to see 2%. Doesn't mean that we need to get to 2%, but the Federal Reserve is very much aware of one fact. As soon as they lower rates, mortgage rates will come down, more people will be looking for homes, and you're gonna have that housing number in this number go up even faster. Housing, energy, those are difficult to control, and the Fed's very concerned about cutting too soon and then cutting too fast too soon. I'm in the camp, I hate to be in the camp, but I think it's a post-election result that we actually get some Federal Reserve relief. I do think mortgage rates come down before then, but I don't think we actually get all the Fed fund cuts that we were expecting. And remember, 3 months ago, people were expecting 5 or 6 cuts this year, and now they're down to 2 or 3. Okay, we've got one more poll question, I believe, before I wrap this up and turn it over to our cyber team. But what best describes your travel plans for MBA secondary for May 2022? I'm attending. Let's set up a meeting. I'm planning on attending. I haven't decided yet, waiting for Q1 results, and I don't plan on attending. And remember, these are the CPE questions, so we need to answer all 4 of these. I can't remember how many we actually do. And we'll give everyone a second. Obviously, Richie May will be there. I'm speaking on a panel on Tuesday afternoon at 1:30, the shameless plug department. Michelle Richardson from Plaza Mortgage and Goggin from BSI are already confirmed for that panel. So hope to see a lot of you in New York. And if you're interested in setting up a meeting, please reach out to me or Nathan or your favorite Richie May person that's not me or Nathan, and we'll get a meeting set up. Gabby, how are we doing on the polling here?
We're looking pretty good. There might be 1 or 2 who still need to get their votes in. So if that's you, I'll give you another couple seconds here.
All right, I always try to dance long enough to get everyone to get their CPE credits. I'm just impressed that I got the year correct. And then a lot of people on this call are not planning on attending, and I will say that I do think that it's going to be somewhat light this year in New York. It's an expensive place to go, but hopefully folks will come out here for MBA annual in October, and it won't be snowing at the end of October. All right, before I wrap this up and send it over to the team cyber here, I'm going to give you some insights and some walkways. I just was at MBA Advocacy Conference last week, so I'm probably going to change some of these bullets that are on this slide. But as you think about it, obviously controlling costs, as Tyler talked about, and increased reliance on outsourcing is likely to remain a priority in 2024. I can tell you just from the Richie May team that does outsourcing from our CAS unit, we're busier than ever. And it's not only just the accounting side, but it's the cyber side as well, which we will talk about shortly with Alex. Don't forget, and I know it's hard to not hear the news, but it is a presidential election year. And remember, depending on how the White House goes, CFPB, Ginnie Mae, FHFA could all have change of leaderships. So for those that are working on current policies that may change, just be aware it's always changing in industry. One of the little nuggets that's out there is that the 2020 and 2021 vintage MSRs are starting to just decay a lot due to natural payments. Be very cautious of understanding what those cash flows look like. Payment shock from rising insurance costs is a huge topic in Washington, D.C., right? So again, is that going to cause delinquencies? What's going to happen to servicing portfolios? What's going to happen to your servicing advances? Something very much to be aware of. Basel III Endgame, well, I've talked it, we've beaten it to death. Look, I think there's material changes coming out. Chairman Powell talked about changes. Barr talked about changes today. I don't think that gets implemented as planned. I think that they may have to repropose. I think there's certain elements that may go through, but I think the Basel III Endgame rules. Trigger leads, huge topic out there in the industry. If you have built your business model on trigger leads, you're going to have to maybe adjust. Those trigger leads, the when the representatives are telling us that they're applying for a mortgage and they're getting hundreds of calls and hundreds of texts, there's going to be some trigger lead legislation here, and it's really going to limit who could be there. And finally, and I'm going to turn this over to Alex here, but cyber. I know cyber is an issue when people want to talk to me about cyber risk. I could barely get my phone to turn on and people want to talk to me about cyber risk. President of Ginnie Mae, I was at a conference, TMBA, Texas Mortgage Bankers Secondary Conference. Elena, president of Ginnie Mae, talked for 10 minutes on cyber risk. And it's not just in the mortgage space, right? But Alex and his team are gonna talk about specific mortgage risk, but it is rampant across all the industries. Casinos are getting shut down, and it is a hot topic. You cannot have a mortgage conversation without cyber. Therefore, Alex, take it away.
Thanks, Seth. That's quite the lead up. I think it's no surprise to everybody on the call here that this is a topic of interest. I'm going to talk a little bit about high level of the recent trends we've been seeing. Obviously, we've been seeing a lot in the news, trying to figure out what's exactly going on. We've been working with a lot of clients, helping them work through some of the difficulties that they have with some of these breaches. But we're seeing them more and more in the mortgage industry. From this, we're seeing millions of records that are leaking out there. We are seeing an overall customer confidence shaken, both from those that work with companies that are being attacked and those that get their loans serviced through them. So we've seen a lot of that, and as such, you're going to see a continued expansion into the regulations and fines that are going out there. If we talk about the SEC rules, 17 CFR Part 229 and a few others, really focusing on the requirements to disclose the cybersecurity breaches in your 8K, 10Ks to make sure that it's out there. What's following with that is a little bit of an ambulance chasing we've seen, where some of the attorneys that are out there are looking at these, seeing that they're publicly posted, and then going after and trying to get a class action lawsuit against. So it kind of adds a little insult to injury on there, but very common, especially in an industry where they're trying to figure out if there is negligence or if this is just bad luck. You also seen NYDFS, if you're operating in New York at all, 23 NYCR 500, and I'll add some links in here as well afterwards so you guys can go take a look at those. We've seen that as an expansion with notifications as well as the requirements when it comes to what you need to do from your cyber program. So it's not just about, hey, you got to notify people, but it's also you need to start following a few rules within there to make sure you're doing the proper due diligence when it comes to securing the customer information that all of the mortgage organizations hold so dearly as part of a big part of the business. Lastly, and certainly not least, and there's going to be a lot more. Oh, sorry. The state privacy laws. We're seeing expansion in that. I'll show a map here in a minute on this. But really, we're seeing a continued expansion of the different states that have privacy laws in place, and we're encouraging our clients not to focus on a whack-a-mole game of finding it, but instead creating a little more strategic approach when it comes to cyber. Let me go next slide there. The question that keeps coming out is the mortgage industry a target? I mean, I think it's hard to deny the increase, right? It's been all over the news, a very, very popular subject of, all organizations are coming to us worried about their cyber. Everyone we talk to is kind of wondering, is this a peak that's going to go away, or is this something that, we need to really block in and get our cyber posture up? And it's very much the latter. We've seen this industry after industry where there might be a lack of regulation or when it comes to cybersecurity. We're looking at the banking industry, and FFIEC have been very, very strong on their compliance and regulation requirements for years. But obviously there's a lot that is getting in place now for our industry that hasn't been there in the past. So there hasn't been a command to stay on top of cyber. So the gangs see that. That said, we're definitely seeing a focus, but the industry hasn't changed that much outside of it. Other industries are seeing increases as well. They do like to hop on to the latest news story, and figure out where they can get their name out in the news when we talk about the cyber gangs. So low-hanging fruit would be organizations that have a lot of PII, personal identifiable information, PII, Obviously, there's a lot of that in the industry, and then not having the compliance or requirements to regulate and make sure that you have that secured is a problem. This isn't a mistake to have the 2014 article on the right there. Really, what I wanted that takeaway is 10 years ago, we were seeing that investigation that over 70% of mortgage lenders could be putting sensitive financial data at risk. What I'm trying to get across is we've known about this for some time now. And we've kind of been lucky to have gotten this far without it being too big of a focus. And I think it's starting to get under the radar or get on the radar for everyone now. Lastly, I know, oh, sorry, one more there. I know Tyler had spoken about, the reduction and pullback on spend that we've been seeing in the mortgage industry. Some of that has resulted in cutbacks in cybersecurity. We're seeing it from a lot of our clients. We're going in and they are really pulling back to the minimum that they have to do from a compliance standpoint. The problem is that when you're focusing only on the compliance items, you're doing a little bit of good, but really it's checkbox activities. So we encourage all of our clients to focus on continuing to expand in cyber and continuing to make sure that they're increasing their posture, because this is a journey, and I'll touch a little bit more on that. So what's happening? And without getting too technical here, I did want to just bring up some of the things we're seeing and just the variety of attacks. To Seth's point, it's not just the mortgage industry. We're seeing some very advanced tactics used through every industry right now. Multi-factor authentication obviously has been one of our #1 recommendations for years now. However, organizations out there that are using text message based multi-factor authentication, we've seen motivated attackers utilizing that. It's a technique called SIM swapping, essentially just swapping the identification for your phone so that they can receive the text message. Been a recommendation from the industry for many years now to avoid that sort of multi-factor authentication. App-based is much better. We are seeing some advanced techniques when it comes to that. So make sure you're following best practices when it comes to multi-factor. Social engineering, the people element, I mean, it's been one of the #1 things that we've been seeing for a very long time. When we talk about social engineering, we talk about the ability to convince someone to give you information that you're not supposed to have, or give you credentials you're not supposed to have. I think we've all gotten very used to the phishing emails and reporting those, and hey, this looks a little funny. With AI's advancement, you're going to see a lot more impressive email phishing links that are coming over that might make you look a little deeper. So keep your eye out when it comes to that. But when we talk about vishing with a V in front of it, that's voice phishing. And has actually been responsible for a couple breaches you've seen in the news. That's essentially calling by phone and just trying to convince them that you're maybe with tech support or something like that, and getting credentials that way. From that, they then get into the environment and take advantage, and that's where the ransomwares and everything comes from. Cloud security misconfigs. This is a big one with the post-COVID world where everyone moved to the cloud, some in a hasty manner where they didn't have time to get all security controls in place surrounding it and just wanted to make it accessible so that all employees had access. We highly recommend that the clients come back and take a look at the security configurations within there and make sure that it's set up properly. We're seeing this as a big avenue of attack for attackers that know that it was set up with the idea of speed over security. Third-party breaches or information disclosures, so third-party risk management, just making sure you know who you're trusting with your data. Because even if you're doing all the right things from your internal cybersecurity standpoint, we're seeing a lot of attacks coming from the third parties. So maybe you trust a file transfer system that has a lot of sensitive information, including social security numbers. You need to make sure you're asking the right questions when it comes to that, building a very good internal third-party risk management. That's just going to become a bigger and bigger part of it as we have more and more connections and we're sending our data to more and more places. We need to make sure that we're asking the right questions to the individuals that are managing that data. Lastly here, basic web application attacks. So we see this with a lot of our clients we're working with. So if you have a web app that you've created, a web application, a website that you can log into, anything like that you've created for your organization, that needs to be regularly checked at least annually to make sure that it doesn't have any glaring vulnerabilities. We see many of these we go into, and they will literally change a few just bits and pieces of the URL, and they're able to look at all users in the system. We've seen that as a common issue with a lot of these web apps. And if you are out there creating software for the industry, make sure you have not only regular testing, but you're following some best practices when it comes to securely developing that software. So these are all really popular common attack methods that we're seeing. I don't encourage you to go and say, all right, we want to focus on these 5 things and these 5 things only. Building an actual program around this is going to be a big part of that, which I'll touch on in a second. Next slide here, we're going to look at the privacy laws here. I know I already touched on this at a high level, but as you can see, there's a continued expansion with at least 3 right now in cross committee, and you can see a variety of them in cross chamber. So these privacy laws are going to continue to put fines out there. And we're seeing varying levels depending on your negligence and how they deem negligence. But I've seen as low as 2,500. I've seen as high as 7,500 per record, potentially, if you have any data breaches. So this is a big focus. But once again, don't focus on the whack-a-mole game of just following each one. Instead, try to wrap an entire program around it. So this gets back to the whack-a-mole that I keep focusing on really hard here. While we've seen a ebb and flow of some of the attack methods that I listed before, it changes. It's a constant change based on technology changes, based on industry preferences, based on vulnerabilities that come out there that are within applications, or whether people are paying attention or not paying attention. Things become kind of hot button issues and then they disappear. So we constantly see an ebb and a flow of what the preference is for attacks and how it's happening. And because of this, you really need to focus on the holistic cybersecurity journey. Not just focusing on what's hot this year, not just making sure you have a couple things in place, but really making sure that you're building a cybersecurity program within your organization and you're keeping up to date on it. It isn't just a one-time thing, it's a journey completely. So really everybody asks from there, what can we do for success? The aligning with the framework is going to be a big part of this. There's a variety of different ones that are out there. NIST cybersecurity framework is one very popular one. You can enable your cyber and IT teams to go out and provide the needed information for them to understand how to align a cyber program with a framework. If you don't have the resources in-house, there's obviously a lot of options that are out there for getting help, but mainly making sure that you're enabling your IT and cyber groups to get out there and look at it. As I've hit a million times here, the specific tactics or whack-a-mole, we don't want to focus too much on just one little thing. Regularly testing of your environment. So you may have heard the term penetration testing. You want to be looking at that from a network standpoint, a cloud standpoint. We talked about web applications already as well. We as we get back into the office more and more, there are security vulnerabilities we're seeing inside offices where people are still putting their passwords under their keyboards and things like that. That does open you up for a lot of options of attack. If somebody is very motivated, they're going to find a way in. So that's something to look at as well. Defense in depth is a coined term in the industry that's very popular. And essentially what I like to caution our clients is make sure you don't trust one thing too much. So you might have a very good antivirus endpoint detection and response. You might have a good security operations center, or you might have a variety of different tools that are out there. There's no shortage of options that are out there in the industry that are claiming that they're going to protect you and fix all of your cybersecurity woes. Really stacking those as best as possible. Obviously, you don't want to just grab every shiny object that's out there, but stacking them together and making sure you have a couple different options for defending yourself is going to be very important. Information sharing groups. This is a huge one with FS-ISAC. With the new Mortgage Resource Committee is available out there that everyone can join. Financial services information sharing groups are really important. They just had their annual meeting in San Diego a couple weeks ago. I went, and I'm always surprised at the lack of turnout that we see from the mortgage industry. So I think that's a shift that we're recommending a lot of our clients start to move into the MRC side of the house and start to share information. When we talk about the attendees, we were looking at some of the
A little bit longer to answer this question. As a reminder, if you would like CPE credit, this is one of the 4 questions that you need to answer. So it looks like we still have a few who might need to answer. All right, with that, we're going to close this poll now.
Test it once a year is the biggest one there. Okay. 2% without one concerning, but I understand and appreciate the openness on that. I mean, I think it's just something to throw on the radar that you need to go and take a look at. I would say the 17% there that haven't tested it in over a year, probably want to look at it as if you don't have one. A lot of times in incident response, if you have an outdated plan, it's actually worse than having no plan, because you spend a lot of time tracking things down that have changed, and that can actually cause more problems than if you just had to figure it out on the fly. So definitely recommend that top 2 group where you're testing it. A lot of our clients will ask us to help them test it for once a year, and then they'll do their own once a year as well. So there's kind of that dual where you're getting an outside party's opinion as well as having it inside. That's a great way to approach it as well. So yeah, everybody keep on top of your incident response and your cybersecurity items. If you guys have any questions, I think we'll have information distributed afterwards, and I'm more than happy to have a conversation with anyone who needs help. Thank you, guys.
Awesome. Thank you, Alex. As we talked about, cyber is a huge topic. Everyone's talking about it. From President Jimmy on, it's everywhere. Again, we're gonna have a couple questions that we're gonna run through real quick, but just kind of summarize, right? Look, real-time data, real-time benchmarking, real-time expertise is needed to navigate these tough times. There's a lot of changes coming ahead, right? Whether it's presidential changes, whether it's regulatory changes, whether it's new laws affecting originations, affecting loan officers. We'd even touch on commissions and the settlements that are going out there, and whether or not those actually hold, and how it may change behavior of your loan officers and how you interact with customers. for instead of the traditional sort of real estate model. And then cyber. Everything's about cyber these days. Everything's about cost. Everything's about outsourcing. So Nathan, I'm actually going to go to you first, and then Tyler, I've got a question for you on FTEs. But Nathan, this one came in. What are some of the common areas that we are seeing as a firm that people are outsourcing these days in order to try to control those fixed costs that Tyler talked about?
Yeah, that's a good one. There is a lot of interest in this area because I think a lot of companies have figured out that, as Tyler highlighted in his slides, it's all good and well to staff everything out internally when companies are large and times are good, margins are strong. I can have a full compliance department, legal counsel, and I can, build out a really robust, cyber team and data, team of data analysts and everything else. And that's great. It's all good and well, except when volume comes down 60 or even 70%, it's very difficult, as Tyler mentioned. And I think he's going to, as he mentioned in his remarks, that a lot of the bloated cost to originate right now is in corporate overhead. It's the non kind of direct expenses, and so what companies are looking to do is shed as much of those as possible and do that through outsourcing, trying to leverage technology in some areas. Though I think this kind of like shiny vision of technology and robots doing all the work in the mortgage industry has largely been somewhat of a goose chase. It hasn't really materialized, and we can see that in the data. It hasn't really materialized in the form of savings. And so I think it's driven companies to go back to the more tried and true method of outsourcing and relying on fractional talent that is external to the company to drive those costs down, rather than staffing those positions out as full-time positions, because a lot of them really aren't full-time positions. And so to start maybe where the presentation today ended off with, incident response plans, for example, right? Just as one example, in the cybersecurity area, I would say that some of the breaches that have happened and become public in the mortgage industry here over the last year, they are shining examples of companies that probably did not have well-defined incident response plans, and they stumbled. You can see that they stumbled, whether it was with notification to those that they needed to notify, or notification, including to borrowers. They stumbled on the forensics that needed to take place to figure out how it had happened and how significant the breach was. And so that's just one example where I think companies have figured out that, okay, cybersecurity is definitely one of those areas. So to answer that question, Seth, cybersecurity is definitely one of them. They don't feel like they need to staff that out internally. It's not really a full-time job for anybody, and so they can do it on a fractional basis. And our team has done that in a lot of cases for mortgage clients around the country. I think another big one is in the accounting area. Companies have figured out that it's difficult to reduce comp or hold comp flat of accounting professionals because there's such a shortage of accounting professionals. They can find a job in about 5 minutes. And so they're losing really valuable mortgage experienced accounting folks. And so they're outsourcing the accounting function. I think another common area is in compliance. The compliance area, whether it's outsourcing internal audit or just some of the more pure kind of straight up compliance functions, including, the role of the general counsel and things like that. They're just, they're also looking at outsourcing, processing and underwriting. As I mentioned, there's been this dream of automated underwriting and processing, and there's been some components of that have been used and have probably provided some meaningful benefit, but not enough. And so, they're looking at that ability to outsource and offshore, processing and underwriting functions as well. So I'd say those are probably some of the more common ones.
Great. Well, we like to thank everybody for their time. We're just at the top of the hour. We do have that survey. We would love to get your feedback here at the end. But like to thank all the panelists there. A lot of data, a lot of good things, a lot of takeaways. And look, there is a lot of optimism out there for 2024, right? We're off the bottom of originations. We're off the highs of rates. We've got more data out there. We've got cyber plans in place that can help people. So please reach out to your favorite Richie May representative, see if we can help you. But again, thank you for your time. There's a final survey just for feedback, but Gabby, would like to wrap it up.
Thanks everybody for coming.
Oh, there you are, Gabby.
Thanks, everybody.
Yep.